Hey traders, this is Blake Morrow with Trader Summit, and it is Friday, and I have Mr. Jim Welsh from Macro Tides here to break down all of these crazy moves that we've seen this week. Jim, it was actually kind of a quiet week, but a lot of data points moved the market a little bit, and I would speak specifically on the weekly unemployment claims,
Right.
and then
Right.
also the University of Michigan consumer or lack of consumer sentiment today.
Yep.
So what was your read on some of this activity that we saw?
Well, to me, it's a continuation, Blake, of kind of what we saw last week. When we talked last Friday, it was kind of like, okay, the Fed meeting, the employment report kind of overshadowed the ISM manufacturing, the ISM services numbers, both of which came in fairly weak, and the prices paid components moved up, and we'll look at that in a second. And so to your point, claims going up. A few weeks ago in the May macro tides, I wrote about how Challenger and Gray they measured announced layoffs, and they've been ticking up for 4 months. And historically, there's a pretty good correlation to changes in their survey going out like 3 months and unemployment claims. So again, my belief has been as we get to mid-year and beyond, we're going to see the employment market and labor market weaken more than people are expecting. And so to me, this was just the first hint. The key will be the continuing claims because the weekly numbers bounce around a lot. So I wouldn't overstate what happened with the weekly claims. I think the continuing claims are more important.
Jim, I'm in the camp that a lot of the jobs that we have created, especially let's say post I don't want to say post-COVID. I want to say post-inflation surge that we've seen. A lot of them are the jobs aren't your typical white collar jobs. There's a lot of
leisure, hospitality.
Yeah, yes, exactly. A lot of
concentration.
services jobs out there that can easily be cut, and that's why I'm fearful that if it gets into the minds of employers that we are indeed seeing a slowdown and they want to cut their workforce because they've already cut some of the hours that have been worked, but they just decide to cut the workforce, it's going to weigh on the economy and we're going to see jobs lost. Maybe that would be my case, that jobs are lost a little faster than one might think. Am I on the right path here, or what do you think?
I think so. I've been writing about it really for a few months because if you look at full-time jobs, they've actually, over the last year, been down. They've been negative. And part-time jobs that make up the difference. And the difference is the establishment survey, which is the official monthly job total one. If you take out a second part-time job, they count you as you've got another job. That adds to the total. Whereas the household survey doesn't have that same definition. So you take on another part-time job, it's not going to add to their job total. So the spread between the full-time and the household survey has been over 1 million jobs. This last month, it was 175,000 new jobs was the official number. The household survey, I think, was an increase of 182 jobs. So you're right. I mean, this has been my point is this is the exact same thing that happened going into the 2001 recession. The 2008 recession is you saw a gap widen. And I think part of it is that, people are hiring part-time jobs because they know they can get rid of them, which is exactly, I think, the point you're making.
All right. Well, Jim, you did bring a lot of charts. I want to go through them and see what you're looking at here. So let's start off with your tighter lending standards chart. Can you tell us why you brought us this piece of information?
Well, again, we've talked. There's two types of financial conditions. There's the financial conditions that are calculated off of financial markets. So if stock prices go up and bond prices go up and the dollar goes down, those are market-based, and they've eased significantly since last October. The Main Street financial conditions are what are people paying for loans? Do they have access to credit or not? And so lending standards, this is a report that comes out quarterly from the Federal Reserve. So this is for the first quarter. And, last year there was a huge increase in lending standards being tightened. And a lot of people look at this line and I think they misinterpret it, Blake. They see it's declining. Oh, the banks are starting to ease off. No, What's happening is after a huge ramp up, where more than 50% of banks were increasing lending standards, only 20% increased them even more. And on top of it, the percentage of the banks that are reporting that the spread between, let's say the prime rate and what they're going to lend money at is widening. So it means they're adding on to whatever the Federal Reserve has done. And the point being is the longer that lending standards are tight and the availability of credit is restricted, it does weigh on economic activity, especially for small businesses that are way more dependent on the bank for funding, as opposed to big companies being able to issue bonds. And half the jobs in this country are created by small businesses. So again, I just thought it was, this report just came out last week. And it's kind of like, okay, timely to remember, folks, this is what's operating in the background. So while everyone is like, woohoo, the economy's doing so great, if you look at this chart, you can see how tightening lending standards led and preceded the recession in 2008, led and preceded the 2001 recession, and on the far left, you can see 1990. So lending standards are a big deal. It's like the Fed hasn't done anything with the funds rate since last July.
Yeah.
But banks are restricting credit. So the overall, if you will, liquidity available on Main Street is, getting squeezed. And that historically has always had economic repercussions. There's been some special factors. Government spending has been a big one this time. Excess savings because of the pandemic has stretched the lag time out, but it doesn't negate what's actually happening on Main Street. So that's why I thought, this was timely, because again, it feeds into, I think that the economy is going to slow more than people expect as we get to mid-year and beyond. And you can see it has to drop below the zero line, which is when banks are actually easing lending standards.
Got it.
Helping
Okay.
the economy. Okay. And, we're at 20%. We're not even close.
Got it. Okay. All right. So the next chart you brought is regarding ISM, because ISM was a bit of a disappointment last week. So what are you seeing here?
Well, okay, the overall services number. Again, services comprise 80% of GDP. Goods are less than 15%. So this is an important thing to watch. It dropped below 50. It very well may bounce next month. But if you go back to 2016, most of the time it was always above 54. So we're kind of, again, the area where it's not a positive for the economy. New orders. Well, maybe things are going to get better. Well, new orders tick down. And again, going back to 2016, you can basically see, other than the spike in 2020 and late 2022, we're at the lowest level. So we're not going to get redeemed and know that we're going to get redeemed because, gee, look at new orders are up at 60. That's not the case. And then finally, prices paid. There's a good correlation between ISM Services and the paid component. And all I'm saying is everyone's thinking about inflation coming down. We're going to talk about that in a minute. But over the next 6 months, I think it's going to be more sticky. Well, this adds credibility to that position.
All right. And the next one is regarding employment. So, yeah.
Yep. So again, comfortably below 50. You can see, other than the 2020 and again, late 2022, this is not good. So if we're talking about labor market weakness, like we were a little bit ago, well, this is supportive of the idea is, well, is the labor market going to get stronger or weaker? Well, this is clear cut. It's not getting stronger. The degree of weakness we'll have to see. And the chart on the right shows the NFIB, National Federation of Independent Businesses. This is the outfit that really gathers data from small businesses. And historically, that index leads what happens with employment by about 4 months. Well, you can see it's dropped below the 50 mark, which is the demarcation between growth and contraction. And, it implies, again, are we going to see the labor market strengthen in coming months? The odds are very, very slight of that. The odds are much greater that we're going to see employment deteriorate.
All right. Well, this is a chart that you have brought to the table regarding delinquencies. Now, this is a big deal because the assumption is, you're trying to keep up with the Joneses, so you're putting money on credit as savings have depleted. So what are we seeing
Yeah.
here?
Well, again, if you look at the left chart, which is the delinquency rate, compared to the financial crisis in 2008 and 9, okay, it's not up there, but at the same time, you look at both these measures, they are at the highest level they've been since the financial crisis. And to me, Blake, which is equally important, is the trajectory. I mean, this is going up at maybe what, a 75-degree angle.
Mm-hmm.
I mean, it's like, well, it looks like it's got a lot of momentum. And again, this is with unemployment near a 50-year low. So obviously there's a segment of the population that the level of interest rates is really starting to bite and hurt. Starbucks reporting soft sales. Those are anecdotal evidence that people are being forced to pull back. At the grocery store, they're trading down from the brand names to the store names. Why? Because they can save a few percent. And the actual rates that people are paying, this shows credit card rates are actually just a little bit above 22%. Personal loans, 12%, 8.3 for car loans. So again, this is going to, in my view, weigh on economic activity. We're seeing the stress showing up in the delinquency rates, but for the average person who's been, okay, I can make my payments, but are they going to have, excess money to go out and keep spending? Maybe we'll cut back on going out to dinner, not so frequently, or we won't take a movie or a concert or whatever else. So all this stuff, I think, is slowly gaining traction on the economy.
Well, and let me stop here and say, guys, gals, if you like what Jim brings and presents to the table, we're going to get into some of his views in the markets. Make sure you give him a thumbs up. It's free to give him a thumbs up. It's also free to subscribe to this channel and hit the bell icon so you're notified every time a new interview with Jim comes out, because these are going to come out in Europe over the weekend, European times. Some of you might be sleeping, but you'll get notified as soon as you wake up. And so, yeah, if you do appreciate what Jim does here, putting it all together for you, make sure you let him know. Now, Jim, the next chart, because I want to see how this translates into markets. But the next chart you brought up is you brought the dollar. Now, I know we're going to get to stocks in a minute, but look, the stock market seems very immune to anything you're throwing at it right now. So, but the dollar, you've consistently, called for a decline in the dollar, and I've been slowly moving over into your camp over the last couple of weeks. So, what are your thoughts here?
Well, again, we're getting data that shows the economy, in my view, is slowing. I didn't include it because I just had already so many charts. The City Economic Surprise Index. Well, it's going straight, I shouldn't say straight down, but it's been declining rather resolutely. So what's happening is more and more reports are coming in below estimates than above. All right. And I think the dollar is responding to that weakness because, again, my view has been the Fed's not cutting rates because inflation's coming down. The Fed will wind up cutting rates because the economy is going to slow more than expected. And I think the dollar is responding maybe a little bit to both of those. And if it's a triangle pattern, it implies a decline down to around 102-ish. You can see that lower trend line. My guess would be is if it gets down to that upper lower trend line, is that a non sequitur or something? Anyway, that it'll be oversold if it gets down there. So you'd expect a bounce. And then, so this decline, if it's wave D, should be 3 waves: down, up, down. All right. And ultimately, if this pattern plays out, there will be a rebound for wave E that will take out the 106.49 or 52, I should say. And then the dollar is going to get beat up. And my view has been we're going to see the dollar trade below 100 this year. And if this pattern is correct, you're talking maybe sub 95. If not this year, then next year. All of this to me ties in with the idea that the economy is going to surprise the majority of people who now don't believe a recession is coming at all, not even a real slowdown. It's going to come as a surprise. And I think that undermines the dollar in part because what's going to happen? the Fed is going to wind up having to cut rates. And so as the economic weakness becomes more pronounced, I think that's a negative for the dollar. Because the U.S. economy has kind of been the strongest economy for quite a while relative to the global economy. And so I just think there's repercussions if it looks like, whoa, wait a second, the U.S. is really slowing.
Jim, I just want to ask you really quick, if the Fed is faced with the question, do they fight inflation or do they fight a slowing economy? You would be under the assumption, my assumption is that they would rather cut rates, deal with high inflation, cut rates to support the economy. Is that a correct statement?
I believe they're going to respond to the labor market.
Okay.
They've got to do a mandate. Okay. So they've seen significant improvement on inflation. There's more to go. And they've been very surprised, pleasantly so, that the labor market's held up. So if we see definitive signs that the labor market is weakening, I think they're going to respond, because if the labor market starts to weaken, it doesn't turn back positive on a dime. It's kind of like these forces have to play themselves out over a period of months and months. And if you see that kind of weakness developing in the labor market, I think it's fair to assume that's going to put more downward pressure on inflation.
Okay.
So the Fed will, so to me, that's the way things are lining up. And I think Powell has kind of shifted, like, hey, we've seen this inflation progress. And so now policy is more balanced, where we can weight equally inflation and employment. A year ago, it was, 80% inflation.
Right.
Well, that's down. So again, the thing I would point out, and this, I find it ridiculous, the people who thought there were six rate cuts, the market rallied last week. Oh, the Fed took a rate hike off the table. It was never on the table. It's amazing to me to see how shallow the quote unquote critical thinking is so often on Wall Street. Like, I mean, I'm wrong too. I make mistakes, but these guys are like, quantumly wrong a lot of the times of what they come up with. And now there's this, I think, thinking that, well, the Fed's going to abandon the 2% inflation target. Well, only if the labor market weakens enough, they're going to say, okay, now we got to put more emphasis on the labor market. But it's amazing how Wall Street consistently comes up with whatever positive narrative they can. And a lot of times it's just based on stuff that isn't legitimate.
Well, we're gonna see that,
We'll find out.
and because obviously you can't shake it in the stock market. But before we do that, all the developments you said with the dollar should be positive for gold. Is that correct?
Yeah. Yeah. I mean, in recent weeks, I thought we would see gold pull back towards 2260. That was the 382 retracement. And what you can see, if you look at the bottom panel, that's the RSI.
Yeah.
In bull markets, the standardized analysis for RSI is 70-30. Overbought if you get to 70, oversold if you get to 30. Well, in healthy bull markets, what happens is you got to upshift those numbers from 70 to 80, from 30 to 40. And the RSI on gold was 85 like 4 weeks ago.
Right.
And so the correction brought the RSI just to at a tiny bit below 50. And, there was a way to say, well, you got a correction, it's a choppy correction. It's not impulsive in any way. And so to me on Monday, given everything that I see happening, those ISM numbers and so forth, I think gold's going to rally. So in the Monday weekly technical review, I recommended buying gold, and I recommended buying the gold stocks, because what the pattern implies is that high at 24.27 was wave 3. And as you know, my bias has been to the upside for months, that gold was going to break out. And so it was like, okay, we're going to get this pullback and then we're going higher. And so on Monday, I just said, you know what, there's enough evidence here to suggest that maybe we're just going to take off here. And I think gold has a chance to, on this push, maybe get up to 2,500, a little bit higher. One of the things you and I have talked about is the 5 exponential moving average in red. The green is the 13. It's just one of those kind of confirmation if a trend has changed. And yesterday the 5 got above the 13, and we're seeing some follow through today, which is encouraging.
All right. Well, and TLT, you've been looking for a correction higher. People say that bonds will never go up again.
Yeah.
Are they done going up?
No. At
Okay.
least, my view is that you had 5 waves down from 2020, the high at 179 in TLT to 82. Think about the magnitude of that kind of a decline.
Right.
5 waves meant we were going to get a rally. So in late December, or actually last October, pardon me, I recommended buying TLT, and it rallied up to 100. At that point in time, in late December, I said, we're going to see yields go up because everyone's looking for 6 rate cuts. That's not going to happen. And so TLT was expected to decline. It got below 87.78. I thought it would. We might see a divergence. We did. The 5 and 13 moving averages have crossed positively. So the last, if you will, piece of technical evidence that a low is in place will be if TLT is able to get above that upper downward sloping line, which is at about 92 and a quarter. So my bet would be we'll maybe get up near that, then look for a pullback, and then we should see fireworks to the upside.
All right.
Fundamentally,
Well,
as we've been talking, Blake, it's like the economy is going to slow more than expected. And yeah, the Treasury's borrowing a ton of money. But, one of the things when the Fed last week cut the amount of QT from 65 billion to 25 billion, or from 60 to 25, pardon me, that means the bond market has 35 billion less to absorb every single month of
right.
Treasury. That's a tailwind.
All right. Well, let's talk about how the stock market's going to take it, because stocks have been just cruising higher.
Yeah,
This
yeah.
looks like your advanced decline line. What are we looking at here?
Well, that's the lower panel. It's the cumulative running total every day. If 1,200 stocks are up and 500 are down, you got a plus 700. And if day after day more stocks are going up than going down, the advanced decline line goes up. Historically, major market tops have occurred when you get a divergence where the S&P makes a higher high, like in October of 2007, but the AD line didn't confirm it. In 2021 and 2022, the AD line made it a high in November. In January, when the S&P made a higher high, the AD line did not confirm it. Well, we don't have that kind of divergence happening here at this point. So I can't oh my God, the sky's about to fall, because this suggests statistically that's not likely. Does it preclude a 5 to 7% correction? No, we just saw one in April, and the 80 line made a new high. So my only point is, from a longer term perspective, I think a bear market's coming. And one of the things that will give me greater confidence that one has arrived will be if and when the S&P makes a higher high and the 80 line confirms it. Right now, the 80 line is in gear, which to me suggests, pullbacks are likely to be in the 5 to 7% range until proven otherwise.
Your garden variety. All right. Well, here's the S&P
Yeah.
Closer up. What are you seeing here?
Yeah. Well, we'll look at the bottom panel. MACD on the RSI, which is an indicator that I think I actually made up. I find it more helpful than just looking at the RSI. It smooths things out a little bit. Obviously, you can see it's overbought. And I'm looking for a pullback. From a price pattern standpoint, we're at a crossroads, because I can count an ABC up to the high we made this morning, which would imply a drop below 49.54. Like A down, ABC up for a B, and we're going to see a C wave that takes us down towards 49.54. The bullish pattern would be it's wave 1, 2, 3 up to today's high. We'll get a modest pullback to maybe 41.50 or a touch lower. And then there's going to be another push up to a higher high. And then that'll look like, well, you got 5 up from the April 19th low. And that would be a bullish scenario where, all right, there'll be another pullback. But after that pullback, the market's going to experience a very strong rally and get to, 5,500, 600? I have no idea. But near term, both patterns call for a pullback.
All right. So that's the bottom line, is that
Yeah.
today's high might stick. So
I think at least for a little bit, because
Okay.
both patterns imply a pullback. The
Well, you can
bullish one,
update. You can update us next Friday, Jim. So,
absolutely.
all right. So,
Yeah. Okay.
CPI is
Yep.
this week, and it's going to be what many look to create some fireworks. So tell
Yep.
us what
Yep.
you are seeing going into this
Okay.
next week.
So, when the April CPI came out, I said it's going to be an ugly number and the market's going to sell off, because if you look from March of 2023, we were only subtracting 8 basis points. So if the monthly was up 30 basis points, we were going to see the CPI jump from 3.2 to 3.5, which it did. All right. Now look at the takeaway from April of 23 is 43 basis points. So if the current month only goes up by 30 basis points, you're going to subtract 13 basis points from 348, which obviously, as I have there, 335. Well, 1 basis above or below will cause it to be rounded up to 340, or potentially rounded down to 330. And the same thing's happening with the core. You're taking away 47 basis points. If the increase is only 0.3, you're going to be at 360. So my point is, after 3 months of negative CPI news, we're going to get a print that shows it declining at least by 1/10 and maybe by 2/10, just depending on obviously how much inflation gets recorded for April of this year and the rounding effect. So the key will be, how do markets respond to that? My assumption is it should be positive. I mean, the markets have not liked bad inflation data. You would think a good report. So the most telling feature will be not if it rallies on the good news, but if it tries to rally and doesn't take out, let's say, today's high. And then that to me would imply that we would see more selling follow that. So, but we're going to get better news than we've seen in 4 months on the CPI. The PPI, I don't track that as closely. That comes out, I believe, on Tuesday.
Yeah.
And
Y-
this story may be the same there as well.
So, Jim, I was looking at all the G20 countries this week and looking at last month's data, and there's very few countries that have had a miss on CPI or producer prices. I was looking at wages. I was looking at all sorts of metrics.
Yeah.
And so everything across the globe has come in stronger. My assumption, with that being said, is whatever expectations are, people are going to expect those expectations to be met. Therefore, that if they come in a little weaker, as you were suggesting, than forecasts, we might actually see a rally in equities and maybe a little bit of sell-off in the dollar. But how it plays out after that is going to be really critical. Do we breach new highs in stocks? Does the dollar hold, or does it really get smacked? That's going to be critical, right?
Yeah, absolutely. I mean, again, when markets react rationally to a piece of news, like the March CPI came out on April 10th and it was bad news and the market sold off. That's rational. If the market had rallied, it's like, whoa, what's going on here? So to me, sometimes paying attention, as you're pointing out, how the markets choose to respond to this will be more telling than maybe the news itself. The market's overbought. So, to me, it increases the chance that people, as you point out, are maybe leaning toward looking for a good number and they get it. So if it only goes down a 10th, it's like, okay, well, we got the 10th. 2/10 on one of those two numbers obviously would be more demonstrative.
Yeah.
So I just think that, again, technically the market is set up for a pullback, and the nature of that pullback will be very instructive in terms of what comes next.
So, Jim, this week I got your weekly technical review in my inbox. How do other traders get your information and your analysis?
You go to macrotides.com and subscribe. There's a discount for Trader Summit followers. Again, I do special updates and special buy and sell recommendations when I think something. So the weekly technical review comes every Monday, but if something happens in between, I send something out. And then the monthly macro tides looks at a lot of the fundamentals that we talk about just in greater detail and weaves the story. So macrotides.com, or send me an email, Jim Welsh Macro, and I'll send you a recent issue.
Jim, so much great information that you bring each and every week. If you guys and gals have enjoyed this, make sure you give them a big thumbs up. And Jim, I wish you the best next week. I look forward to meeting back up with you next Friday. Have a great week.
You do the same, Blake. Thank you.
Thanks. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.